estate investors are already familiar with the traditional return drivers. We have things like NOI growth, cap rates, leverage, capital improvements. Those four levers have shaped real estate returns for decades. You increase the income, you reduce the expenses, you improve the asset, you manage debt, and you ultimately benefit when the market values the income stream more favorably. But outside of real estate, the strongest companies in the world usually have one thing in common, and that is that they're not dependent on perfect market conditions. Companies such as Berkshire Hathaway, Microsoft, and Apple, these companies have endured cycles because their balance sheet gives them time, liquidity, and optionality. Sometimes in tough markets, the best thing to do is to do nothing. And strong balance sheets that these companies have allow them to do that. If you compare that to companies like Sears or Hertz or Bed Bath and Beyond, this is where operating problems were made worse by financial weakness. The lesson is simple. A strong balance sheet does not guarantee success, but a weak one can force bad decisions at the worst possible time. And that is where Bitcoin introduces something new for commercial real estate owners, and that's a fifth return driver. It's balance sheet appreciation. And here's what I mean. When a real estate owner holds Bitcoin at the entity, the portfolio, fund, or even the family office level, part of the ownership value is no longer tied only to the real estate itself. It's no longer tied to the rent growth, the leasing activity, or cap rates, a refi. A portion of the owner's value is now tied to a liquid global monetizing asset that can appreciate independently of the real estate market. That changes the equation entirely. It does not make a bad property good. It does not replace underwriting. It doesn't eliminate risks such as vacancy, debt, or operational. But it gives the owner another source of balance sheet strength. And in commercial real estate, balance sheet strength matters. A Bitcoin reserve can help you bridge a vacancy. It can help you fund the next tenant improvement. It can reduce refinancing pressures. It can provide liquidity during market downturns. It can help absorb unexpected expenses. It can preserve your purchasing power while you wait for better market conditions. That is very different than having all of your net worth tied up inside of a illiquid property portfolio. Real estate is a powerful asset class, but it's not always flexible. Bitcoin adds that flexibility. It's giving the owner a liquid reserve asset that sits beside the real estate and strengthens the overall capital structure. That's why I call it the fifth return driver, not because it replaces the first four, but because it adds a new layer of appreciation independent of the real estate markets. For long-term owners, this is becoming increasingly important because the future of commercial real estate will not only be about who owns the best buildings. It's going to be about that, but it will be who has the strongest balance sheet, who has liquidity and liquidity when others don't, who can maneuver when others are stuck, who can grow their purchasing power while others have to sit back and wait for the right opportunity. Bitcoin provides the real estate owners a new way to create that flexibility, that liquidity, that optionality. It's a competitive advantage. That's why I call this the fifth return driver. And forward-looking real estate owners are going to adopt this. They are adopting this. They are going to benefit disproportionately because of the things I've laid out here today. I hope you'll consider this strategy. And if you have any questions, please drop them in the comments below or DM me. I'd love to chat with you a bit further. I'll see you next time.